Hey everyone, welcome to our podcast. We're thrilled to be back after a short break for key IR conferences here at the US and Canada. I hope everyone's summer is going well. It's one of the hottest on record, so stay hydrated and stay cool. Now, in the next 20 minutes, we'll share our macroeconomic recap of the first half of 2023. We'll take a look at some of our top of the year predictions with a look back at our 2023 big picture investor relations outlook. And we'll explore predictions that came true, or maybe in some case fizzled, and then take a quick look at what might be in store in the back half of the year. I'm thrilled to have my colleague, Chris Blake, join me today. Chris is an executive director of advisory innovation and technology within our investor relations solutions team here at S&P Global Market Intelligence. In his current role, he provides insights to the investor relations teams through shareholder surveillance and targeting and digital solutions. He really does it all. He authors a monthly insights report on capital flows across the capital markets. Chris has been contributed in his investor relations research for IR Magazine and Institutional Investor. Chris has over a decade of experience of working in investor relations teams and in various roles across IPREO, IHS Markit, and now S&P Global Market Intelligence. All right, Chris, what can't you do? And how's your summer going, by the way?
Hey, thanks, Carmen. Happy to be here. I'm doing my best trying to balance staying out of this crazy heat that you mentioned while also keeping my kids from going crazy being in the house all day. I don't think I've ever been so ready for fall to get here as fast as possible.
I hear you. You know what, though? There is some hope on the horizon here. I went to the grocery store the other day, and they had Halloween candy out already. So I think everyone is ready for fall to be here.
My wife's already thinking about Halloween decorations and when pumpkin spice lattes will be back.
All right, Chris. So if you remember, in 2022, there was lingering COVID-19 difficulties, and we saw the invasion of Ukraine in February, and that was followed quickly by an energy and food crisis and surging inflation and debt tightening. As far as numbers goes, and this is from the World Economic Situation and Prospects report that is published by the UN, and it was published in January of this year, they said world output growth is projected to decelerate from an estimated 3% in 2022 to only 1.9% in 2023, marking one of the lowest growth rates in recent decades. With all these issues in mind, many were predicting a global recession to take place in the first half of 2023. But I don't think we saw that. So I just wanted to pick your brain on what's going on in the first half of the year here.
It's certainly been an interesting first half of 2023 so far, and a lot of the things that you touched on are either still around. Look at what's going on in Ukraine. You can hear a lot of different opinions on how important they are as we think about things like inflation. Certainly, if you were to focus just on the performance of the stock market so far this year, it would seem like everything's a lot better. The S&P 500 is up almost 20% at this point in the year. Everything looks to be improving, a lot of good returns for investors. But at the same time, it really feels like people aren't quite ready to say, hey, there's no more recession fears or everything's great. And there's a lot of reluctance to be overly bullish in this market. In fact, I was actually reading the mid-year review and outlook from T. Rowe Price the other day, and they used this term that really resonated with me, saying that a lot of investors right now are reluctantly bearish. So they want to believe in this market rally. There's a lot of positive things that could be pointed to, but nobody quite feels like they're there yet. And that actually lines up with a lot of what we're hearing directly from investors. We have a team here, a perception team, that reaches out to investors on a regular basis and gets their feedback on the market. And they publish a monthly report called the Investor Management Index. And in that latest investment management index, we actually see most investors telling our team directly that they're really not feeling too great about equity returns in the next couple of months. Their outlook is better than it was a month or two ago, but we're really not seeing the shift that you would expect to see given the rally in the market so far this year.
That's an interesting point. I think a lot of us are trying to get a handle on what's going on in the first half of the year and what might be going on in the second half of the year. I was listening to our very own Chris Williamson's webinar from last month, and that was titled Q2 2023 Global Economic Outlook, Drive Decisions with PMI. Biggest takeaway from that webinar was that the PMI hit a 16-month high in April, and a majority of the growth was in the service sector. It also noted that the financial services industry saw a slight rebound due to the panic dying down around rising interest rates. I think it would be interesting to see what happens in the second half of the year. What sort of signals or what other sort of inputs are you taking into consideration when analyzing the first half of the year and then looking ahead?
I actually recently saw an article or a headline that summarized or talked about the fact that at JP Morgan right now, they have three different research investment groups. And depending on which group you talk to, they've recently said they're bullish on the outlook for the market, they're neutral on the outlook for the market, or they're bearish. We have a textual data analytics group here at S&P Global that publishes some great research looking at what do the actual words in a given earnings call or transcript tell us about how companies or people asking calls on those earnings calls feel about the market right now. And at the same time that PMI is near those highs that you mentioned, the sentiment that we measure on transcripts is one of the highest that we've had. It's actually in the top 12 quarters of earnings call sentiment of the last 15 years. At the same time, you look at the underlying financials for those companies who have this strong sentiment on their earnings calls, and a lot of them have actually seen lower, revenue or EPS growth compared to even just last year. So a lot of the data that we're looking at and a lot of these points that we're using to try to read the tea leaves for the rest of this year feels like we're at this state of improvement, but improvement is really a relative term. And so we're better in a lot of places than we were, let's say, a month ago or 2 months ago. But certainly on a lot of these fronts, we're not better than we were 2 years ago as we think about 2021 as being a really strong and positive year for the capital markets. This is something as we think about, investor takeaways on the market or investor outlooks. BlackRock actually had in their mid-year outlook this discussion around kind of the new regime that we're in and how different things are in the capital markets. And the fact that given all of these different kind of macroeconomic pushes and pulls, it actually brings a lot more of the importance back to focusing on individual securities and individual companies and how those look, as opposed to really trying to focus too much on broad asset classes and just, what equities are going to do or what fixed income is going to do through the rest of the year.
Mm-hmm. To be fair here, I think comparing any sort of activity to the insanity of 2021 may not be completely fair. 2021 was pretty crazy. But yeah, you're right. So like if you were to take, it's a mixed bag. So if you look at some indicators, we're saying, okay, we're bearish. If we're looking at other indicators, okay, we're bullish. So there's just mixed signals out there. In our big picture report, we did predict that institutional selling would be a headwind for stocks if recessionary and inflationary fears remain top of mind for investors. In your paper that was featured in the big picture report, you also mentioned that in 2022, institutional investors were a key source of selling activity in the market. And this did contribute to market volatility. And then in some instances, on the flip side, the selling was a reaction to that volatility. And then just shoring up, like what you said, what the equity markets are actually doing. They're performing positively. You said year to date, we're up 19% at close of the first half of the year. It was up by close to 16%. And we got close to levels we hadn't seen since the insanity that was the summer of 2021. So given that, how the equity markets are performing, what do you think that means for capital flows?
It's a great point. And tracking institutional capital flows and trying to look at their impact on the market's always been a really interesting view on, like you said, what's driving the market and what's reactionary to it. And we see a lot of times, more months than not, long only active institutional investors have a bias towards selling, even when they have complete control over what securities they want to invest in. There are some overarching movements of capital that they're always fighting against, in particular, the shift from active to passive investing. And so when we try to think about what capital flows tell us from an institutional investor perspective, even in the months when they're selling, there can still be a bullish hint from them if the selling's less aggressive than it is historically. And so as we headed into 2023, we had seen the rate of selling and the amount of selling from institutions was near some of the highest levels that we've tracked when looking at capital flows. And that trend continued in the first couple of months of 2023. But as the market started to rally, particularly as we look at the month of May, and there was these big legs higher in the market, we started thinking, hey, is there a chance that this move higher is starting to get some fuel from institutional investors? And at first, the data shows us they were a little reluctant to take part in the rally. So for the month of May, institutions were still kind of selling more than not in the face of this rally. And a lot of the source of support was actually coming from some short covering. So short sellers who had a lot of bearish positions in the market. In order to cover those positions, they have to buy, and that helps move the market higher, kind of in a self-fulfilling prophecy. But as we look at the first week of June, those long-only institutional investors finally realized this rally looked like it was about to stay and it wasn't going to be short-term. And the first week of June was the largest one-week inflow into equities that we've seen for institutional investors since we started tracking this monthly data back at the end of 2021. Now, in subsequent weeks, we have seen some shifts back to selling by institutional investors, but overall, the month of June was one of the lowest net selling months for institutions, and we had those individual weeks of significant buying that we really haven't seen from this group over the last 18 months. So we're going to be looking at this really closely, when we start to look at the July capital flows and through the rest of the year. But if we continue to see these pockets of inflows from institutional investors, I think that bodes really well for the ability of this rally to continue into the rest of the year.
Yeah, that's really interesting that we saw a little bit of a turnaround there from those institutional investors. So it seems like it's not a far stretch to say there is some appetite there. And thinking about in terms of deal making and M&A and equity offerings activity, we did recently repost our Q2 equity issuance and the M&A activity. And I had a chuckle because one of the sections of this report is titled Equity Issuance Freefall Comes to an End. So it's like, going back to, is this bearish or bullish? Like it's promising, but the fact that we're in a free fall is kind of scary. Let's go back to the big picture report. Some of the items that we had talked about in the big picture report was around how best-in-class IR teams should have a robust and up-to-date sustainability and governance strategy, in addition to understanding what investors expect in the future in terms of benchmarks. This helps the IR team kind of craft a story on differentiating performance and helps them find the right investors. Talk to me about how you think IR professionals should be thinking about prepping for a second half of the year and maybe some insights in what happened in the first half of the year in terms of activism.
The big picture report, as you mentioned, it highlighted that 2022 saw a pretty significant uptick in the amount of activist campaigns, and in particular ESG focused activist campaigns. And we were predicting or suspecting that trend was not going to go away. Here at the halfway mark for 2023, activism remains elevated compared to historical norms. It continues to be a market environment where, despite some of the recovery in the broader market, there are a lot of individual companies out there who have underperformed or have situations that activists are looking to take advantage of. In particular, there's certain sectors that activists have seemed to focus on. There was actually a report from Barclays that highlighted nearly 60% of all the activist campaigns in the first half of 2023 were either in the technology, healthcare, or industrial sector. In particular, we've actually seen a pretty big impact so far this year from the changes to proxy rules as it pertains to director nominations. So I'm sure most people in the IR profession are familiar with this, but there was a change in 2022 to the universal proxy rules that requires all of the proxy cards to include basically everybody who's up for nomination. And we've seen that have a pretty significant impact so far in the first half of this year on how many director votes can actually go in different directions than they may have in the past. And so for IR teams looking at the rest of 2023, as always, it's really important to always have a preparedness plan for an activist. Regardless of what your company situation is, you always want to know, hey, if an activist came into my stock, how are we going to react? What is our emergency plan? Because you don't want to wait until the day comes that an activist is in the stock to start figuring out how you would react to it. Beyond that, continuing to focus on delivering your company's message is really important. In this market, given all of the volatility that we see and this sense among investors that one wrong move could really negatively impact a company's performance. It's really important to have your own story and how you fit within the current macroeconomic conditions front and center and something that you're comfortable telling.
Yeah, that's a great point, to always be kind of prepared as an IRO, on what is my company story, what are differentiators, and why is that important, and kind of puts us above the pack. Something that was interesting that you also pointed out is that no one's immune to activism these days, right? With the regulatory changes, and then we saw a bunch of campaigns launched against these blue chip bellwethers. And so the takeaway that I'm getting here again is no one is immune, and everyone is better off being prepared for some sort of activism campaign to be launched against your company, whether that be around the board or around sustainability and other governance issues. I hope this wasn't going to be true, but I think we did see kind of a pullback on sustainability and governance campaigns this year. And I have a feeling that's more to do with, people's attention span when it comes to, okay, there's a lot of market volatility still going on and some basics and fundamentals that they really have to hone in on before doing the above and beyond around sustainability or governance. But I do feel like if things eventually settle down, that folks might be turning their attention back to sustainability. Chris, if you had a little bit more advice on what it means for IROs, what sort of advice would you give them given this mixed bag of signals? And again, continuing our theme of it's just, it's hard to tell what the future holds here.
Yeah, for sure. I think it's actually a really important time with all of these different factors in play for IR teams to kind of be revisiting and refocusing their proactive outreach to those active, long-only institutional investors that we talked about. So given the uncertainty in the market and given some of the thoughts from names like T. Rowe and BlackRock about the increased focus or the increased importance of security selection and individual stocks for their portfolio, the time is really ripe for a company with a clear, concise message on why they're positioned well in the current environment to reach out to these active investors, pitch their story, and start to build those relationships for new investment in your company. As we look at the capital flows and those net inflows that we saw the first week of June, there is an appetite out there for some of these institutional investors to put money to work, but they don't want to do it just into a blanket broad move into a single sector or into a single asset class. They are going to be looking for the individual companies within sectors, within industries that are the best opportunity for them as a way to differentiate in this market and to protect against volatility. So for IR teams, what that means is you're probably more likely than historically to be able to reach out to some of these investors and make the case for your stock. And in doing so, you help to build up that support in your stock right now against the volatility backdrop that we have in the market. But also, as we think about things like activism, the number one thing that an activist needs when they come in a stock is support from other shareholders. So the more that you're proactively out there encouraging new investment into the stock and building positive relationships, that's one of the strongest defenses that you can have against an activist in the future, is an investment base that's more likely to side with your company versus a dissident slate.
Yeah, that's a great point. And it does seem like this day and age, even those passive shareholders can turn into activists, which is making sure as an IR professional, you are engaging with all of your shareholders and having some sort of regular cadence and a plan around any sort of contingency plan on any sort of market volatility or an activist investor campaign or anything like that is launched. Chris, I'm sorry we are running out of time here. I thought this was a great conversation on looking at the macroeconomic backdrop and what that means for IROs, and I appreciate all of your insights here. Real quick, I just wanted to end with just one word from you or one sentence, maybe not just one word, but the one sentence in advice that you would give to IROs.
Yeah, sure. I think if there was one piece of advice that I could give right now in, kind of one word would just be proactiveness. I think the most important thing right now for IR teams is to be reaching out to investors proactively, planning for, what you would do in emergency situations proactively, and looking at the rest of the year and kind of identifying the opportunities that you want to go after. That would be my one key piece of advice.
Thank you, Chris. I love that word. I think it definitely speaks to the IR professional as a whole. You have to be on your toes. You have to be proactive here. And thank you to our listeners. That is all the time we have for today. A very special thanks to my colleague, Chris Blake, for joining us. And to our listeners, I hope you found valuable insights throughout this discussion, and tune in next month for a look at how younger generations are playing an important role in the future of IR. Have a great day ahead, and I hope you enjoy your summer. Thank you.